Have you been keeping up with the recent news? Have you noticed the current state of bank loans and mortgages? If you have, you will see that the financial situation in America is undergoing significant changes. Panic is already taking hold, and the potential consequences remain uncertain. In this video, we invite you to join us as we delve into the expanding financial panic, exploring its root causes and discussing ways to safeguard yourself against the impending crisis. Are you ready? Let's go!
Hi, I'm Jim Rickards, editor of Strategic Intelligence. I'm going to talk today about gold versus Bitcoin. It's a very popular debate. I'm happy to say that gold and Bitcoin are both forms of money, but it's a liquidity preference. Which do you prefer in a crisis?
It is widely recognized that we are currently experiencing a recession, and its effects are clearly felt. While we all hope for better days, it is crucial to understand that recessions are integral to the business cycle. The duration of recessions varies, and the United States has encountered multiple recessions in the past 2 decades, such as those in 2000, 2007, and 2020. But this recurring pattern suggests a cycle with approximately 7-year intervals. However, the present recession from 2020 to 2023 deviates from this expected timeline, introducing uncertainty regarding its underlying causes. Despite the 2-year respite between 2020 and 2023, regrettably, the recession anticipated in 2023 is expected to introduce further challenges that could potentially escalate into a full-blown financial crisis. Currently, there is a brewing financial crisis that has sparked widespread panic. Should this crisis come to fruition, its consequences will be devastating, casting a dark shadow over America and the global community. It is crucial to recognize that each financial crisis has its unique impact, with some resulting in significant losses, while others may have more limited repercussions. However, accurately predicting the magnitude and duration of a crisis remains a formidable challenge. Jim Rickards suggests that expert guidance is necessary to assess whether a crisis will be large-scale or small-scale, and to estimate its duration accurately. In certain instances, a financial crisis coincides with a recession, leading to a truly catastrophic scenario. One historical example is the subprime mortgage crisis that unfolded between 2007 and 2008. This crisis emerged due to the expansion of mortgage credit, facilitating easier borrowing and mortgage acquisition for a broader range of people. Unfortunately, this contributed to the bursting of the housing bubble in the United States, causing a sharp decline in home prices. As a result, numerous individuals experienced the dire consequences of losing their homes, savings, and jobs. It is important to emphasize that this crisis's impact extended beyond America's borders. Given that the United States serves as the center of global trade, the effects of the crisis reverberated worldwide, affecting economies and individuals on a global scale. Let's discuss a scenario where a liquidity crisis coincides with other economic challenges. During the 2008 crisis, industrial production plummeted worldwide, credit markets froze, and commodity prices experienced a sharp decline. The consequences were staggering, resulting in a loss of over $2 trillion in global economic growth. Jim Rickards suggests that the world only encountered a similar situation during the Great Depression, specifically between 1931 and 1933. Multiple bank failures, consecutive currency devaluations, and a widespread halt in global trade marked this period. It is worth noting that history tends to repeat itself, and we may find ourselves on the cusp of a similar situation once again. The possibility of a global liquidity crisis looms, and the repercussions could have far-reaching implications for the financial stability of nations worldwide. And what if 2023 brings a collision of a financial crisis and a recession, similar to 2007 to 2008? This scenario is not mere speculation. Financial experts like Jim Rickards have pointed out the signs already manifesting. So, what are these signs? Firstly, we see a decline in global trade, as projected by the World Trade Organization for 2023. Additionally, industrial output continues to dwindle while unemployment rates rise. Moreover, the interest rates in America are currently at their highest levels in 15 years as the federal government attempts to alleviate inflation. However, the inflated prices of goods and services erode salaries and wages. Inflation began making its presence known in mid-2021, becoming particularly high by the fall. Federal Reserve Chair Jay Powell emphasized that inflation was transitory during this time. However, by November 2021, he abandoned this stance and acknowledged the persistence of inflationary pressures. Consequently, interest rates started to rise, with the policy rate, the Fed funds target rate, moving from 0 on March 1st to 4.25%. There are indications that it will increase by another 50 basis points on December 14th. If doubts remain about the onset of a recession and financial crisis, one needs only observe the state of banks in America today. The signs are becoming increasingly apparent, suggesting we are already amid these economic challenges. Within just 1 month, the financial landscape witnessed the downfall of 5 major banks. The first casualty was Silvergate Bank, previously valued at over $5 billion in 2022, which declared bankruptcy on March 8, 2023. Shortly after, on March 10, Silicon Valley Bank experienced a financial crisis stemming from poor management, resulting in the FDIC taking over the bank. The third bank to succumb to the crisis was Signature Bank, officially taken over by the FDIC on March 12th after a bank run caused by panicked depositors attempting to withdraw their funds. Joining the list of failed financial institutions in March was First Republic Bank. Faced with a $30 billion liquidity crisis, they were rescued by 11 banks on March 16th, having already lost approximately $70 billion in deposits. Lastly, Credit Suisse, one of the largest banks globally and the second largest in Switzerland, collapsed in March 2023, leading to its acquisition by rival bank UBS for $3 billion. These 5 bank failures, each with unique circumstances, all unfolded within a single month, underscoring the severity of the financial crisis. According to Jim Rickards, the combined losses incurred by creditors and stockholders of these financial institutions exceed $20 billion. Such substantial losses send a clear message to the public that there is a genuine problem with the current financial system. As a result, panic is starting to grip people, leading to concerns about the safety of their money. To alleviate this panic and reassure the public, the FDIC has taken extraordinary measures to regulate these banks. Let me explain how. Normally, the FDIC's highest deposit insurance limit is set at $250,000. However, in response to the bank failures in March 2023, the FDIC has extended its guarantee to cover all Silicon Valley Bank and Signature Bank depositors, amounting to an insurance deposit of over $200 billion. As Jim Rickards predicted, this unprecedented move will deplete the FDIC insurance fund. While it may appear noble and beneficial, the burden will ultimately fall back on consumers and ordinary individuals at the lower end of the economic spectrum. Continuing on this matter, the Federal Reserve has also taken steps to offer additional loans to member banks. They plan to make this extra funding available through the Bank Term Funding Program, BTFP. Jim Rickards suggests that the total cash volume for these loans could surpass $1 trillion. These actions have stirred significant turmoil within the U.S. banking system, leaving everyone, especially depositors, confused. Many questions arise from these moves. Are they indicative of a new policy direction, or are they simply rule-breaking measures taken to protect the interest of a few influential figures affected by the crises of these banks? It's worth noting that the FDIC and other entities like Show a Bear previously guaranteed every bank deposit in America, despite a $250,000 insurance limit. This prevented small businesses with higher balances from withdrawing their funds and causing further instability. I recall the events of 2008 when I, too, was concerned about the safety of my deposits, even reaching out to my bank in London to withdraw my funds. The government seems to have forgotten that U.S. bank portfolios currently hold unrealized losses surpassing $600 billion. Amidst all these challenges, the government continues to provide cash to depositors fleeing the system. It raises concerns about the banking sector's stability. While they may attempt to reassure the public that the banking system is safe and secure, the question remains, have they convinced us that all is well? And most importantly, is the crisis truly over? Well, the answer is no. The panic is just beginning to unfold. Recalling our previous discussion on the similarities between the 2023 situation and the 2008 financial crisis, it's worth noting that the 2008 crisis began in the spring of 2007. The trigger was the announcement from HSBC regarding mortgage losses surpassing expectations, which sparked a wave of panic and set off a chain of events that eventually led to the financial crisis. Significant incidents followed, such as the failures of financial institutions like Bear Stearns in March 2008, Fannie Mae and Freddie Mac in June 2008, and the closure of the Associates General Money Market Fund, among others. However, it was in September 2008 that the crisis reached a critical stage with the bankruptcy filing of Lehman Brothers, which was considered a major player at that time. This sequence of events demonstrates how such crises unfold. In the case of the 2008 crisis, it gradually escalated for 1 year and 6 months. Comparatively, our current crisis is only about 1 month old, yet it has already resulted in the collapse of 5 banks. This situation in the banking sector reflects the broader state of the economy. While the Federal Reserve has stepped in to guarantee all depositors, it's important to recognize that this issue is not isolated, but rather widespread. One key aspect to highlight is the excessive creation of debt for investment purposes. This trend has been prevalent, and this fundamental issue raises concerns. The current crisis is merely the beginning, and there is a potential for it to worsen rapidly. The implications of this situation are indeed unsettling. Jim Rickards has raised concerns about how technology could potentially exacerbate our ongoing crisis at a faster pace. The ease and accessibility provided by technology have transformed the dynamics of financial events, particularly in the context of a bank run. Consider the scenario where you hear that Silvergate Bank has collapsed and one of its partner banks, where you hold an account, is on the brink of failure. In such a situation, your immediate response would not be to visit the bank to close your account physically. Instead, you would swiftly transfer your funds to a secure account, a process that can be executed using your phone and a simple wire transfer within seconds. Whether moving a small amount or a substantial sum, the convenience of transferring money through a few clicks on your device has significantly changed the speed at which customers can react to events and potentially trigger a bank run. Gone are the days when you would have to queue at a bank, waiting for your turn to make a withdrawal. Technological advancements have empowered customers to swiftly and efficiently move their funds, exerting pressure on banks like never before. However, before we proceed, if you find this information valuable, we encourage you to like our video, subscribe to our channel, and hit the notification bell so that you can stay updated on our future content. Returning to our discussion, Jim Rickards emphasizes that the current panic will escalate faster than previous crises, mainly due to the collective memory of the 2008 financial crisis. Individuals who have witnessed such events unfold already take preemptive measures by withdrawing their funds and investing in alternative assets. There is a lack of confidence in the government's ability to restore normalcy, and this skepticism is not unwarranted. What is particularly concerning is that the crisis is transitioning from the banking system to the foundation of the global economy, the US dollar. As the world's reserve currency, the consequences of a failure in the dollar would reverberate throughout the international financial landscape. We can already observe signs of this shift in the news, with numerous countries actively seeking to reduce their reliance on the dollar. China, for instance, is promoting the yuan as an alternative for global trade, while Russia has already commenced international trade in yuan. Additionally, countries such as Saudi Arabia, Brazil, and Iran have traded with the yuan instead of the dollar. These actions indicate a gradual erosion of confidence in the American government. Regrettably, this loss of faith extends beyond bankers to nations themselves, and their patience is wearing thin. The inevitable outcome of this trajectory is the collapse of banks and, ultimately, the collapse of the dollar itself. Furthermore, we will likely witness a surge in bank failures in the upcoming months. Jim Rickards predicts that the U.S. Treasury will soon face a shortage of funds and be compelled to borrow more. Based on these forecasts, it is evident that the current financial panic is only in its initial stages and is bound to intensify. The impact will not be confined to the banking sector. It will extend to the wider economy, transitioning from bank runs to a more pervasive debt problem within days. As we have discussed thus far, the government's options for addressing the crisis are limited, and their desperate attempts to alleviate the panic may inadvertently accelerate the downfall of the financial system. Given this backdrop, it is crucial to consider how one should respond and safeguard their interests amidst the looming crisis. While we cannot prevent the imminent crisis, we can proactively protect our wealth and assets. It is prudent to explore strategies that prioritize the preservation of wealth in these uncertain times. Seeking expert advice and devising a well-thought-out financial plan can help you navigate the storm ahead. By staying proactive and making informed decisions, individuals can better position themselves to weather the incoming crisis. It is important to note that personal financial circumstances may vary, and consulting with a financial advisor is crucial to tailor strategies to individual needs and goals. According to Jim Rickards, acquiring gold is the first crucial step in protecting oneself amidst the impending storm. Gold is considered a reliable asset that can help individuals weather financial crises. Even the government seems to acknowledge this, as evidenced by recent developments. Jim Rickards highlighted on Twitter that members of the U.S. Congress introduced the Gold Standard Restoration Act, a proposal to anchor the value of the U.S. dollar to a specified weight of gold. This serves as a significant indication of the significance of gold in times of economic uncertainty. It is advisable to invest in gold to ensure your safety. There are various ways to acquire gold, including purchasing gold bullion or investing in mutual funds and exchange-traded funds (ETFs) that track the performance of gold. However, Jim Rickards strongly recommends acquiring physical gold bullion as the preferred method. Gold bullion refers to gold bars or coins from reputable online dealers or local collectors. It is important to conduct thorough research before engaging with an online dealer to avoid falling victim to scams. By acquiring gold bullion, individuals can establish a tangible and enduring value store that can safeguard their wealth during turbulent times. As with any investment decision, it is essential to carefully evaluate your financial situation and consult with experts or financial advisors to determine the most suitable approach for your needs and goals. If you found this video helpful, do well to subscribe to our channel. Also, hit the like button as well as the notification bell so you don't miss out on any of our videos. And we want to hear from you. Please share your thoughts and experiences in the comments below. Thank you for joining us on this extraordinary journey.